Welcome to Mad Money. Welcome to Cramer. Other people, my friends, I'm just trying to make a little bit of money. My job is not just to entertain, but to educate, teaching. Call me 1-800-743-CNBC. Tweet me at Jim Cramer. Markets can be capricious. Markets can be moronic. But if you own stocks, the market's always right. There's no alternate universe. So it doesn't matter if the action's crazy. It doesn't matter if the market's literally playing rock, paper, scissors with Meta as the rock and Microsoft as the scissors. You have to deal with the closing prices, and they can be brutal. Dow inching up 56 points, S&P declining 0.13%, NASDAQ losing 0.72%. But those are much higher than where it was at one point in the day when it looked like the market was going to take a real Microsoft-related header that's incredible proportions. And it didn't pay any attention to Meta's good stuff. You know, though, it's hard to believe that Meta, which had been written off as a company that spends way too much on AI just last quarter, could rally more than 10% today as those investments paid off in spades. Last quarter, Meta had been the scissors. This time, it's the rock. Meanwhile, Microsoft, perennial rock, isn't spending enough to meet the demand for AI, or at least in the right places, because it seems to be putting its resources behind the wrong stuff. They've become the scissors, and they got crushed, down 10%. Truly horrific, horrible to watch. Is that fair? Like that has something to do with it. Let me explain. The market's been obsessed with AI, everything you need to profit from it, right? The company that's making the most money from artificial intelligence is obviously NVIDIA. Their chips are the foundation of the entire industry. Of course, NVIDIA's chips can't just be plugged into the wall. They aren't bricks with transistors stacked up like statues. They are giant boxes filled with all sorts of tiny circuits, packed into servers that burn so hot that you need to spend fortunes on electricity just to keep them cool. They consume enough power that we need dozens of new nuclear power plants and natural gas plants and solar farms to keep them everything running. The companies that are making money from these chips are all those that live in and around the data center. Fellow server components like the memory and storage makers, they've been huge winners, you know that. So have those that produce power, help get electricity to the data centers, provide backup generators, because we don't have enough power in the system. Think Eaton, GE Vernova, the electric company, especially the nuclear ones like Constellation. There's Cummins, there's Bloom Energy, I like that. There's Brookfield, and there's Caterpillar. Hardly a day goes by without one of these generating a monster set of numbers. Today was Caterpillar's turn. The earnings from its generator business hit the stock soaring 3.4%. A year ago, Cat was at $393. Today, it hit $665. Tonight, SanDisk, a memory device company, reported earnings and gave a forecast that sent its stock soaring. Buy. But let's speak truth right here, right now. I listen to CEOs constantly. I read their words. I hear their calls. I talk to them. And until last night, I hadn't heard a single executive who actually uses AI, not participates in the making of it, but uses it, actual client state unequivocally, just with no caveats, that AI is the greatest force multiplier, that it can make his business fortunes, that it's accelerating the sales and earnings, that AI is changing the company's fortunes in a way that is just extraordinary. And last night, it finally happened, and it is Meta. Leave it to Mark Zuckerberg from Meta to say that AI has allowed his company to offer the greatest advertising vehicle in the world, aimed at his user base. Oh, by the way, it's just 3.5 billion daily active users. That's like half the people in the world, for heaven's sake, or like close to it. This Meta knows everything about you. And if you've been a Crest user your whole life, I swear they could get you to switch to Colgate. It could get you to buy something you never thought about. Zuckerberg, where is he? Is he at his desk? Is he in Hawaii? No. He's in your cerebral cortex, silly. He's in your darn vagus nerve. And his company will present your brain with exactly what you want. You'll watch. The darned accelerated computing makes sure of that because the video is better and cleaner than ever. And you will buy what they advertise because generative AI is finally that powerful. No more scissors. This one is a rock. For certain. It's not done going higher. Now, though, let's look at Microsoft, Mr. Softy, as I called it when it came public. It's tough to watch this great business, this rock, play the scissors. There's so many amazing things about this company, which has dominated software for 40 years. It's been unassailable until last night, when we heard, frankly, a convoluted story. I mean, like,
don't buy.
They said that Microsoft isn't going to spend enough money to meet its artificial intelligence demand, but at the same time, it was proud that it had 15 million paid users of Copilot. 15 million! Oh, wait a second. They have 1.5 billion users. They were proud of that 1% of these people who pay to use Copilot. How many use Clippy? What does it tell you? How about that maybe Copilot just isn't that big a winner? It's like Microsoft makes dog food that dogs don't want, right? And somehow they think if they slap new and improved on the side of the can, the dogs will clamor for it. Dogs can't read! Of course, I simplify. But when I listen to the conference call, I can only conclude one thing. Unlike Meta, Microsoft may not be making all that money on AI, even after all the massive investments in OpenAI and all that stuff. Certainly less than expected. We keep hearing that AI is eating the software industries alive, right? Kind of like when software was eating hardware. Something, by the way, that Ben Reitzes over at Melius predicted would happen years ago, and it's finally coming true. AI is enjoying a smorgasbord of endless proportions right now, and that includes software as a service companies that used to be tremendous secular growers. Microsoft never seemed to be on the menu, though, until last night. It's kind of like an hors d'oeuvre. Yep, last night, Microsoft played the scissors, and Meta was the rock. No two ways about it. Is it time to give up on Microsoft? What, are you out of your mind? Absolutely not. Remember, this is Microsoft. Remember the game. Meta worked from loser to winner in one quarter. Microsoft can do the same. It's just kind of have to bite the bullet here. I haven't bought this stock for my Charitable Trust in 2 years. We have a size position. Don't need to. But I am betting that next time around, Microsoft could come out on top, and I'm looking at a level to buy Microsoft. Satya Nadella and CFO Amy Hood will figure it out. They're smart. Yes, the situation is that fluid. I'm just waiting for the velocity of the decline to dry up, and then I will decide. Club members, stay close. I know it's hard to believe how quickly this market can change its attitude. Last night, I heard a disastrous car company speak. Turns out it's actually a robotics and cyber lab company, and I want to buy. Yes, Tesla's the paper that turned into scissors in one session. I didn't like it as a car company. Boy, I love it as a cyber cap and humanoid robot juggernaut. Call me a buyer and give me 5 robots while I'm at it. After the close, Apple reported a magnificent quarter. Just tonight, a robust top and bottom line beat driven by staggering levels of demand for the iPhone 17 that nobody's looking for. Wall Street was looking for iPhone sales of less than $79 billion. The number came in at $85 billion. I knew they were popular, but I mean, come on, I underestimated them. Now we still have to see what they say on the call about some important topics like how they'll deal with skyrocketing memory prices. Still, after seeing these great numbers for the last quarter, I have an idea. I've been thinking. How about own it, don't trade it? Now, if you only have one takeaway from this entire segment that I've just gone through other than the vagus nerve thing, the bottom line is you must not give up on any of these companies because they are run by really smart people with lots of money. They're nation states. I thought Alphabet would be carrying in the face of AI, but I bet when we hear from them next week, we'll realize, AI search winner. Alphabet may be next week's rock, and it may be even making more money from AI than Meta. Is Amazon paper or scissors? I think it's paper, but this game changes so quickly, you may actually have to rush your judgment. Unless, of course, you're NVIDIA. They aren't playing a game at all. They're running the game. They're the house. That's the best place to be. Whew. Oh, yeah, calls. Silvio in Florida. Silvio!
Hi, Jim.
So,
no club member, first-time caller.
Oh, thank you.
Glad. Thank you for all your help.
Oh, thanks a lot.
Jim,
thank you.
I'm calling about a biopharm that has struggled last year. Share price dropped nearly 40%, but year-to-date has gained about 20%. This biopharm has a first-mover advantage in GLP-1 global market, which is projected to reach about $170 billion by 2031. Mm-hmm. Mm-hmm. He has a P ratio less than 20 compared to Eli Lilly's 50s plus, while still on 50% of the global market share. Right. What do you think about NVO?
NVO, I kind of liked it when I spoke to him. I got to tell you, I kind of warmed up to him when I was in San Francisco, and I said, you know what? Like, get that stock a little down more. Maybe we do some bring. But I love Eli Lilly and David Ricks, and what can I say? You know, as long as Eli Lilly and David Ricks are putting up those numbers and they get that pill form soon, I think that Novo is a hold, not a buy. Rock, paper, scissors, Vegas. All right, and that's VAGUS time. Today's lesson is that you should never give up on the hyperscalers. I just said horrible things about Microsoft, right? And yet what am I? A buyer. All right, Man Money tonight. Royal Caribbean cruise higher after the earnings today. And I'm getting to the bottom of what's continuing to propel the travel thesis with the company CEO. Then Big Blue proved last night that it's ready to earn some big green. I'm breaking down the post-earnings IBM story. And I'm checking in on the state of the construction market with the CEO of elevator maker Otis. And that includes the service business. Stay with Cramer.
Don't miss a second of Mad Money. Follow at Jim Cramer on X. Have a question? Tweet Cramer. #MadMentions. Send Jim an email to madmoney@cnbc.com or give us a call at 1-800-743-CNBC. Miss something? Head to madmoney.cnbc.com.
On a freezing cold day here in New York and a not so hot day for the averages, I want to focus on warm weather and sunshine. I'm talking about Royal Caribbean Cruises, the largest cruise line in the world by market capitalization, which reported a solid quarter this morning, then gave us incredibly strong guidance, sent the stock up nearly 19% today, second largest gainer in today's session. Management was very bullish on recent booking trends, and their full-year forecast for 2026 is spectacular. What makes them so confident? Let's take a closer look with Jason Liberty. He's the chairman and CEO of Royal Caribbean Cruises to find out. Mr. Liberty, welcome back to Mad Money.
Hey, Jim. Great to talk to you, and welcome and greetings from South Florida.
Oh, you're very lucky to be in South Florida. Now, let me ask you something. A lot of people feel that the travel bull market might be on its last legs. I look at this and I say, there is something very major going on for you who have this kind of outlook. And it just seems it's spectacular. Can you give me some of the factors or making these bookings unbelievably great?
Sure. Well, I think first and foremost, Jim, just foundationally, when we look at our business, we've been building this dream machine of having the best brands in their segments, having the best ships, having the best destinations that are now expanding. And you couple that with the best people in the world delivering the best vacation experiences in the world. And you couple that with a lot of strong tailwinds, right? We're still a very small part of the $2 trillion leisure market. There are great secular and demographic trends driving this. And we've also invested heavily in AI and other sets of technologies to better personalize and yield manage our business. And collectively, what's that's driving is high quality demand that is supported by a great and new loyalty program that's keeping our guests inside of our ecosystem, resulting in more reps, which is why we're seeing strong booking volumes at higher prices.
Well, it's clear that this whole notion that we hear about, that there might be an oversupply of Caribbean ships, is something that you put to rest today. I'm not going to ever let anyone get away with that canard anymore, correct?
Yeah, I think that's exactly right. I mean, there's always an increase in supply in the different deployments that we go into, and I do think we're differentiated, between the ships that we have on the water, the private destinations we have with Perfect Day, Coco Cay, and the Royal Beach Club that we just launched a few weeks ago, that differentiates us in the Caribbean space. And still, the Caribbean is the #1 destination that our guests are looking to go to. And so I think some of the concerns that are out there, which I certainly can understand, but that is not what we're seeing from the consumer. And I think that's also bolstered by drivable markets. We have more drivable markets here in the state of Florida as well as Texas that go into the Caribbean that lower that cost to the consumer or to our guests. And that's also why that value proposition to land-based vacation is still at least 15%. And so we're still also insulated from any type of concerns that could be out there. And so, as you said, we're not seeing that in the Caribbean. We're seeing similar trends that we're seeing in our broader business with the Caribbean.
Okay, I understand. Also, it's not just the Caribbean. We spoke about river cruises when they came out. You actually introduced them on our show. That was not that long ago. You're doubling the number already?
Yeah. Well, as I said on your show, Jim, this is not a hobby. And so the first thing we wanted to do was to make sure we had designed the ship and we knew how we were going to elevate the experience and do that in our first 10 ships. Demand that we have seen has really been well above our expectations. Our guests, our customers, our loyalty members, their thirst to go on river, not as a substitute, but as an additional vacation experience, is very clear with very, very long waiting lists to get on. So we have full confidence that we're going to generate high quality, strong demand for an elevated river experience here, and that provide easy confidence for us to put an order in for 10.
I understand you also have a new cruise line going out, a whole new line. No one knows anything about it. I want you to talk about it. Really, just tell people on air because it'd be the first time anyone's ever heard about it.
Well, I don't know. It's not a different cruise line. I think you're talking about our new class of ship.
Yes.
Which is coming out. Yes, our Discovery class. And so we of course we like to keep the marketing machine going here in the little things here. But what I will tell you, like we do on all of our ships and all of our classes of ships, is that this will be a game-changing ship in this segment. It's going to continue to build incredible multi-generational memories, which is very much at the heart of our Royal Caribbean brand. So we're very excited about it. The first one will come out in 2019, and we've been designing this ship for several years. And that, coupled with the incredible Icon class for the Royal brand, just drives so much excitement. And these, by the way, these ships are generating Net Promoter Scores, into the 80s. And so that's obviously a great sign of incredible advocacy. And also that our guests walk away with great experiences, which infuse trust.
All right, we'll have to discover those later. Now, one last thing. I was taught by you and by your colleagues and predecessors, this is wave season. People have to recognize when you talk about 2/3 booked for 2026, these are ironclad. It's not like they're looking at it and saying, oh, we're doing okay. This is numbers, raw numbers that we actually can put pencil to and figure out what to pay for Royal Caribbean. To me, it says pay more than it's selling for.
Well, I think that's and that's, by the way, how our yield management tools that are fueled by AI work. We're 2/3 of the way booked for this year, and that puts us in a position to effectively manage pricing. And we try to encourage everybody to book early, not just in order to get maybe the price points that you want, but also to make sure that you're getting the vacation experience you want, which is not just about your booking on the ship, but it's also, and we have been seeing this, the pre-booking activities for all the wonderful things and experiences you can have on and off the ship during your vacation period. So as you said, Jim, we have great visibility into the quarter. We have great visibility in the year. And we feel very encouraged by the trends.
One last question. I know you guys are actually pros at AI. Can we actually think about how many bookings you get during the middle of an NFL game after we look at those fabulous ads?
Well, Jim, I think it's amazing, and I think we're very thankful for the advancement in technology. We have 15 million price points that we're managing every day and growing. And so, as you said, these great ads and these great sponsorships that we have, whether it's during NFL and other sporting events, or Inter Miami that just won the championship this year that we're the sponsor of, that's really where the eyeballs are, and that stimulates them to dream. And of course, in times like this when it's incredibly chilly in different parts of the country, and they're watching football and they're looking at sunshine, that certainly stimulates them to dream about being in the warmth and being on our beautiful ships.
Well, I know it's certainly done it to my family. I want to thank you so much, Jason Liberty. Great day for you. Deserving day. I know how important wave season is, and you've crushed it. Jason Liberty, Chairman and CEO of Royal Caribbean Group. We got to wait till 2029 to find out more about Discover. That's all right. I'll wait for your ads, and then we'll book it. Thank you so much, Jason.
Thanks, Jim.
Everybody's back here for the break.
Coming up, last night's earnings electrified the stock of IBM. So should you plug the tech giant into your portfolio? Cramer's dissecting the data. Next.
Last night, while everyone was focused on the state of Microsoft or Meta and, of course, Tesla, there was another tech company who reported an impressive quarter that people weren't discussing. I'm talking about IBM, one of the great, albeit unheralded winners of the AI era. I went positive on IBM way back in December of 2023 when it was trading at $160. Since then, this company's been reporting some of the best growth in ages, resurgent software business that, among other things, helps customers build their own AI applications. IBM stock shot all the way to 325 at its all-time high last November. We're pulling back to the 300 area for the last couple of months. The last few times I've talked about this one, I've felt kind of defensive. IBM had slipped to $294 as of last night's close. But then they reported, and boy, that stock soared 5% today in response to an unambiguously good quarter, closed at $309. IBM saw its sales grow 12% to $19.7 billion. Wall Street was only looking for $19.2 billion, thanks to the better-than-expected results from the software and infrastructure businesses. On a constant currency basis, sales were up 9%. That was still IBM's best growth rate in more than 3 years. That said, these guys are cleaning up, helped in part by a weak dollar. Their gross margin came in solidly better than expected, which helped them deliver 21-cent earnings beat off a $4.31 basis. Nice. That strong fourth quarter capped off another excellent year for IBM with 12% earnings growth. Not that long ago, it seemed like IBM just couldn't grow no matter what it did. It was a stagnant business. Everyone assumed its best days were behind it. They don't think that now. Under the leadership of CEO Arvind Krishna, is putting up double-digit earnings growth. That makes IBM one of the cheapest stocks in the entire market, not just in tech. Digging a bit deeper into the numbers, IBM's standout software result was powered by strong growth from essentially every sub-segment. Hybrid cloud, that's Red Hat, up 10%. Automation, up 18%. Data, up 22%. Transaction processing, up 8%. Now that Red Hat, their number was technically a little bit disappointing. And this is the same issue that some people quibbled with when IBM last reported in October. Initially, the stock sold off in response when people saw that again. But ultimately, it started skyrocketing because the guidance was tremendous. See, this time around, nobody blinked at the Red Hat numbers. Why? First, it was well telegraphed. But second, the shortfall was partially due to the government shutdown. That's one off. Most importantly, though, Arvind Krishna and CFO Jim Cramer explained on the conference call that while Red Hat used to be the only real growth driver for IBM's software business, it's now just one growth contributor among many. And some areas like automation and data are putting up spectacularly strong numbers. So a modest shortfall from the Red Hat enterprise software business, it doesn't even move the needle. I took heart that IBM didn't need Red Hat to grow faster because there's a real mosaic of strength now. Now, looking at the other divisions, consulting continues, looks very solid. Importantly, it keeps driving business to IBM software and infrastructure products. Their consultants basically tell companies what technology they need. IBM can fill many of these slots themselves. Plus, there's a lot of demand for AI consulting. Companies finished 2025 with a generative AI backlog of $12.5 billion. $10.5 billion of that comes from their consulting business, with the other $2 billion being software. Finally, IBM's oft-forgotten infrastructure division is getting a big boost from what is a powerful mainframe recess cycle. Yes, their big companies still use mainframes. Lots of them. The infrastructure division grew 21% in the fourth quarter, driven by 67% growth from IBM Z, which is that mainframe business. I think those are numbers, just stunning numbers. On the conference call, Krishna explained that this is mostly due to the excellent sales for the Z17 mainframe, which was released last summer. Apparently, this mainframe can process 50% more AI inferencing operations per day than the previous iteration. That makes it very popular with IBM customers, of course. Long story short, it was an amazing quarter. And I'm betting IBM has a lot more room to run, even after today's rally. Now, some of that's simply because IBM rolled out a terrific full-year forecast for 2026 last night. This year, management expects constant currency revenue growth of 5%. Wall Street was only looking for 4.1%. Remember, it's big companies, so that's a huge delta in revenues. IBM also guided for $1 billion year-over-year increase in free cash flow, implying roughly $15.7 billion in free cash flow this year. Again, that was a big surprise. Analysts were only looking for $15 billion. As long as these guys can make the numbers, I think the future's looking real bright for Big Blue. And that's because I'm a big fan of the IBM narrative. In a nutshell, they're selling customers products and consulting services that help them profitably embrace AI. While there are plenty of companies offering AI tools and services at this point, there's a much smaller set of companies offering AI products that can actually help customers save money. IBM's right at the tip of the spear. These guys have extra credibility here because when it comes to their various AI products, IBM's not just the vendor, it's the client. It's like that old hair club for men ad. Oh, and last night, Christian explained that back in 2023, the company set out to achieve $2 billion in productivity savings, mostly through internal AI adoption, by the end of 2024. And as they came out of 2025, that had grown to $4.5 billion in annual run rate savings. Beyond that, everything else, though, IBM's the rare AI winner with a fairly low price earnings multiple. Sometimes you got to find some of those. Even after today's rally, the stock sells for a little more than 25 times this year's earnings estimates, and the estimates may well prove to be too low, as IBM has beaten the earnings estimates expectation for 17 consecutive quarters. Of course, 25 times earnings is still a bit of a premium to the broader market. The S&P trades at 22 times this year's earnings estimates, but I'm happy to pay a premium for such a high-quality story. It's still below these big software as a service companies multiples. So here's the bottom line. IBM's nearly doubled since I started recommending it just over 2 years ago, and after last night's quarter, I think this rally is far from over. The company's just got so much growth coming from mainframes and software and consulting. Best of all, the stock still isn't expensive here. I say buy some IBM if you don't already, and recognize that CEO Krishna has turbocharged the sales and earnings so much that it would be a gift if this $309 stock were to fall below $300. Jerry in Missouri. Jerry.
Jim, thanks for taking my call.
Oh, of course. What's up, Jerry?
Jim, I bought this stock when it was around $130. That was when he said it would go to $150, and it did. So you changed your narrative a little, and you said it'd go to $200, and it did. Then you said it'd go to $250, and it went back down to $150.
Yeah.
And you kind of stopped saying it. So do you still like Palantir?
Yes, I like Palantir. Now, Palantir is trading right now with the cohort that is ServiceNow and Salesforce. By the way, those are great companies. But I think that, look, everything I hear when you hire them, business does better. And that's why I liked it, not momentum. So I can't back away from it right here. If anything, I would say great opportunity to buy Palantir. And it's not like I talked to Dr. Alex Karp. He and I, well, you never know. You never know. Well, no, you kind of know. Anyway, IBM has got so much growth ahead of it, and I don't think the stock's done rallying. But that's a cheaper stock than Palantir, just so you know. I think it's buy. Now, much more Mad Money, including my exclusive with elevator maker Otis. Falling after earnings, your investors getting a buying opportunity in the stock. I'm going straight to the source for answers. Then I'm sharing the one number you need to know when trying to figure out what a stock should be worth. And, of course, all your calls rapid fire tonight's edition of the Lightning Round. So stay with Cramer. What do we make of yesterday's results from Otis Worldwide? That's the dominant maker of elevators and escalators. This time, the company missed earnings expectations by a penny off a $1.04 basis, with sales also coming in a tad light. That's softer orders from America and China. Management's full-year forecast was a bit surprising. Otis is projecting earnings growth in the mid to high single digits. Wall Street was somehow looking for 10%. In response, the stock dropped 2% yesterday and then lost another 1.6% today. It is down 18% from its all-time high last March, but that's in keeping with a lot of other companies that are in the industrial sector. So is this an attractive entry point for a company that gets most of its business from servicing existing machinery, which is really stable? Or are we supposed to be a little more worried? I don't know. Let's check in with Judy Marks, the chair, president, and CEO of Otis Worldwide, get a better sense of the quarter and what comes next. Ms. Marks, welcome back to Mad Money.
Thanks, Jim. I got to tell you, I'm not worried, but I look forward to our discussion.
Okay, well, that's good, because what happens is sometimes, Judy, I think people say, wait a second, our rates are too high. They're not building much here. We hear about all these problems in China. I always come back and say, look, I like the service business. There's nothing that's changed with the service business. It seems just as strong as ever. I don't care so much about the new builds at this point. Am I looking at it correctly?
Jim, the main thing at Otis is service. In the quarter, our service revenues organically were up 5%. Our service margins were up 100 basis points. It was 93% of our profit in the quarter and 91% of our profit for the year. Repair, maintenance, and now this emerging but really growing, fast-growing demand for modernization and refurbishment of older elevators and escalators really puts us in a strong position for 2026. That helped us 11% EPS increase in the fourth quarter and record cash. We've never been able to generate this much cash to help share with our shareholders since our spin 24 quarters ago.
Okay, if you were down here with me in New York at the exchange, what you would see are a huge number of businesses where people like me used to work, and they're being converted. And if they're going to be converted, you can't just leave the same old elevator. I have to believe that this trend, which is some of the governor helped here, but it is going to happen in every major city. There's way too much supply. How will Otis do if you have to refurbish all these elevators that go from office to residential?
Yeah, it's beyond just office to residential. When you think about the aging install base, 9 million elevators are over 20 years old and in service today, in need of refurbishment in the window, and about over 15 years old in China. We had a record quarter. Our orders in refurbishment were up 43% in the fourth quarter, and they were up double digit the entire year. We're going into 26 with a 30% backlog. It is about aesthetics, it's about technology, it's about total replacements, but it is the fastest growing business, and Jim, it is growing synchronously everywhere in the globe.
Now, I do want to ask about the possibility of a president, our president, who definitely wants lower rates, and what that ultimately has done to Otis in the past. If you get rates that come down, are there actually places where there is going to be building that there hasn't been building otherwise because rates are too high?
Well, our North America business has been growing for the last 6 quarters. New equipment orders have been up significantly, building our backlog to where North America, think U.S. mainly, is going in with a 10% backlog for construction. Multifamily's back, Jim. We had a strong multifamily 22, 23, but I think a lot of developers and owners have decided that we have a housing challenge. One way to solve it is apartments and condominiums. We're seeing that grow in every part of the U.S., from the Midwest to the Southeast, but everywhere. So when interest rates go down, the math works a lot better for developers. They get the loans, and we go.
Oh, that makes so much sense. I know that there has been a shortage of single-family home, but that doesn't necessarily mean that there isn't a burgeoning all over the country explosion of apartments just to be able to handle all the people.
Yeah, and the other market that's really growing significantly across the country and Canada is the infrastructure business. Whether it's refurbishing existing airport terminals, the bus terminals, the metros, the rails, or adding new terminals, stadiums, hospitals. Again, we serve and we deliver and service for every building. As long as you've got about 2 stories, whether it's manufacturing, industrial, we're really bullish on the U.S. right now. We've got a great backlog coming into 26. It's refurbishment, it's maintenance, it's repair, and it's construction.
All right, so it's a little bit of a stretch, but I went to a data center, and it was 1 floor, candidly, but there's a data center costs $30 to $50 billion to build. Is there Otis in these data centers?
There are. Typically, they're heavy-duty industrial elevators because they're moving the racks. They're moving the technology, Jim, and they're moving the people simultaneously. It's obviously at a more rugged and robust elevator, and it needs guaranteed uptime. So we are seeing a nice demand signal as data centers build out, not just here in the U.S., but across the globe.
Okay, now I noticed you are hiring. Where are you getting your people? This is the kind of shortage. Your industry is the kind of place where I would expect that it's very difficult to find help.
Well, we now have 45,000 incredibly skilled field professionals, and they are the heart and soul of our business. We're up significantly. We added 2,000 of our mechanics 2 years ago, and we added another 1,000 last year. Not all in the U.S. Obviously, we're a global service provider. When an opening happens here, we're very proud to be working with our union, the International Union of Elevator Constructors. And when an opening happens, they oversubscribe right away because great apprenticeship, great career, no debt, and as I said, a great place to work.
Now, I was at the privilege of going over to that J.P. Morgan building, which is just chock full of Otis. Are there others going up like that? Because it's the talk of the town in terms of just if you're with big CEOs, they all want to go by. I think there's a lot of people who would like to return to the days of downtown. And build buildings downtown, which are you plant the flag. Is it happening anywhere?
Yeah, we're seeing it happen throughout the globe, but certainly in New York. New York's hot right now. I can't speak about all the projects, but there are a lot of new buildings in Hudson Yards. Downtown, you're going to see them shortly. Park Avenue's getting a few more as well. I think what Jamie and his team, David Arena, have done at 270 is spectacular. We're just proud to be their partner. Okay,
last question. I mean, you've been terrific at returning capital to shareholders. What do you think's the game plan for a situation where you're doing really well and the market keeps thinking that what matters is that there'd be a lot more apartments built in China, which is not the story at all?
Yeah, it isn't the story. We basically most years turn back 100% of our capital and the cash we collect. We collected about $1.6 billion of free cash flow this year. We're returning $1.5 billion because we've done a lot more of small buys of bolt-on service providers. It's a service play, Jim. We're going to continue. We actually announced our dividend release again after the market closed today. We're very proud of where we are in our dividend and share buybacks. But for us, we are light capital, low intensive capital. We're going to share this cash with our shareholders. And all I would tell you is it's all about service. Refurbishment, modernization's part of that. And that is going to grow synchronously well above in the teens for years to come.
Excellent. That's what I wanted to hear. And thank you so much to Judy Marks, President, CEO, Chair of Otis Worldwide. Judy, I love you having the show. Thank you so much.
Thanks, Jim.
Mad Money's back in for break.
Coming up, Cramer takes your calls, and the sky's the limit. It's a fast-fire lightning round. Next.
It's time. It's time for the light round. Cramer's brain bites with Robert Gold. He's him in the stock is buy, 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 sell, sell. I don't know the core stock questions at that time. My staff prepares the preference of the file. You playing this out. And then the lightning round is over. Are you ready? Ski that time. Light round, Cramer with money. Let's start with Ivan in Kentucky. Ivan.
Hi, Jim.
Hi, Ivan. Who you got?
I'll be brief, Jim. I've had a position in Rio for about 15 years. Mm-hmm. I can't see a lot of media coverage on the Glencore merger. I just wonder if you had a thought on what happens if they
I
go
have liked
south.
Rio. I used to call it. Let's put it this way. I liked Rio so much, even from when I was at Goldman Sachs in the 80s, and I just think you should just go in and own it. I just think it's a great hedge against all the chaos that we see in the world. RTZ is what we used to call it in the old days when that was the symbol. Let's go to Alan in Florida. Alan.
Hey, Jim, love your show.
Thank
Watch
you,
every
Alan.
night.
Oh,
I'd like
perfect.
to know your thoughts on Armor Residential Real Estate.
Okay, at times I've been worried about this because believe it or not, the gross yield is too high. And this is one of those times. It yields 15%. That is worrisome for me. That is not a bargain. When you see that kind of height in a dividend, that's in a yield, that is not a bargain. I need to go to Jeff in New York. Jeff.
Hello, Mr. Cramer. This is
Hey, Jeff.
from Sodus, New York, on the South Shore of Lake Ontario, where winter has given us 30 inches of snow in the last 6 days and more on the way.
30 inches of snow. At least in Royal Caribbean, you're going to feel like, hey, celebrity, discover, whatever. Wave season. How can I help?
Hey, we love the lake effect snow here in the Rochester area. But the
Okay.
reason why I'm calling, there's a local company in the Finger Lakes whose new fiber technology is making things difficult for a former local company that produces cooling for the data center. Should I hold on to my position in Carrier or sell it? And
Look,
stay
I think
with the
Dave
puppy
Kittler's
zone?
doing a good job. He made an acquisition. Some people don't like it. I know that they changed it. To rely on Europe turned out to be a dicier thing, and he relied on Europe. But he'll come through with it fine. I think you buy it now and put it away. Let's go to Craig in Florida. Craig.
Jimmy, gotta be chilly Cramer. Craig from St. Augustine. Good evening.
I've been the chill man. I admit it. What's up?
Okay, so cybersecurity and software stocks are trading like they're going the way of the dinosaur because of the thought of what AI is suggesting it will replace.
You bet.
The other
you
night you had
T-Rex.
the other night you had the CEO of this company on, and from his point of view, it's gangbusters. The last quarter suggested the same, but the stock certainly suggests otherwise. I know you like it and recommend it. So what is the canary in Rubric's coal mine?
Okay, I like that one. Here's the problem. These are all the same. Okay, it doesn't really matter. What you have to do is you have to wait and shake out. The price earnings multiples are going down. When we see a bottom, we will make determinations. But right now, I do not like. Do I look like a butcher block to you? I mean, honestly, I do not like falling knives, and I will not change my way. And that, ladies and gentlemen, is the conclusion of the Lightning Round.
The Lightning Round is sponsored by Charles Schwab.
It's all about the M, stupid. I'm talking about the multiple, or more accurately, the price to earnings multiple, and what it tells you about a stock and where it's going. In How to Make Money in Any Market, I spend a huge amount of time explaining how the multiple works. Because it's the M, shorthand for price to earnings multiple, that actually determines the price of a stock. This is something that really just confounds many people, even the young hires I taught at Goldman Sachs so many years ago. The M is basically the secret sauce of the stock price. Sometimes it's delicious, sometimes it's disgusting, sometimes it's pure poison. That's That's what I see happening to the enterprise software stocks right now. This is an industry where clients pay you per user, which was a great business model back when their clients had lots of employees. Now, though, the declines in these enterprise software stocks that do software as a service brought forth by sellers concerned about AI replacing employees that clients pay for are downright staggering. It's an Armageddon situation, and it all starts with a guest on the show last night, Bill McDermott, the CEO of ServiceNow. First, let me just say that ServiceNow is a tremendous company with a highly respected CEO. You bring in ServiceNow to rationalize and digitize your company. Most companies have all these back office silos, HR, IT, finance, that create a lot of bottlenecks without generating any revenue. ServiceNow automates the mess, and now they can bring in artificial intelligence to make things even more efficient. They can introduce agentics to help your company automate workflows. They have a view of the entire organization, and with a recent excellent acquisition, can even provide a layer of cybersecurity that many people think is very good. Best of all, ServiceNow knows what your entire enterprise needs. I know dozens of their clients. I've never heard anything but praise. However, this stock has become a nightmare. Down more than 50% over the last 12 months, including a nearly 10% beating today in response to last night's quarter, even though, again, the actual numbers were excellent. So what the heck's going on here? The earnings are fine. The problem is the M, what people will pay for those earnings. ServiceNow's multiple is shrinking. The M is being compressed, and it doesn't seem to matter what Bill does or says. He can order up a huge buyback, as he did last night. He can break records when it comes to how fast his very lucrative business has grown. He can show that ServiceNow's core business isn't being cannibalized by its AI component at all. Business is better than ever. But the market just doesn't believe him about the future, about the forecast. The market's saying his company's going to hit a wall, that AI will ultimately sap all of its profitability as clients learn to do more with fewer users. That's an existential threat for ServiceNow because they do charge by the seat. How do we know this? Well, we look at the price to earnings multiple. At the end of 2024, ServiceNow traded at 65 times forward earnings. In April of last year, it traded down to 42 times earnings. After today's meltdown, it now trades at just under 28 times earnings. And it looks like to me that it's headed lower still. The shrinkage may not be over. In other words, like Ralphie from The Sopranos, ServiceNow has always been a good earner. But Wall Street's saying the good days will come to an end, and the growth cannot be counted on any longer. It's saying the same thing, by the way, about Salesforce, another software company that's doing fabulously, with a stock that's also seeing multiple compression. So the question isn't whether ServiceNow will keep delivering earnings. I think it will. Doesn't matter. Last night when I was interviewing Bill, he was emphatic about the client wins, the incredible growth of buyback. Yet out of the corner of my eye when I was interviewing him, I just saw the stock being hammered mercilessly. And I said, I guess what he says doesn't matter. It was all going down before he even went on a conference call. The M can be brutal. It's like a vote, a referendum. And somehow Bill has been voted off the island. The stock market has said, ain't got nothing for you, Bill. Personally, if I were running a company, I would hire ServiceNow and Salesforce too. They're really great. But I accept the market's judgment, at least for now, because I can't fight. It's too powerful. And it doesn't matter what Bill does or says. It doesn't matter what Mark Benioff says at Salesforce. These stocks are going to trade like they're no longer growth names, even as their growth remains strong. Can the market be wrong? Of course. It's wrong all the time. Can you get in front of a freight train that is the shrinking price to earnings multiple? Maybe not now, not yet. Soon, when we see how low the multiple can go, and it will bottom, these may be worth buying because we're dealing with great companies. Right now, that doesn't seem to matter. But I bet it won't stay like that forever. Terrific companies have a way of bouncing back, but not until their multiples bottom and start to turn around. I like to say there's always a bull market somewhere. I promise I'll find it just for you right here on Mad Money. I'm Jim Cramer. See you tomorrow.
All opinions expressed by Jim Cramer on this podcast are solely Cramer's opinions and do not reflect the opinions of CNBC or its parent company or affiliates and may have been previously disseminated by Cramer on television, radio, internet, or another medium. You should not treat any opinion expressed by Cramer as a specific inducement to make a particular investment or follow a particular strategy, but only as an expression of his opinion. Cramer's opinions are based upon information he considers reliable, but neither CNBC nor its affiliates and or subsidiaries warrant its completeness or accuracy, and it should not be relied upon as such. To view the full Mad Money disclaimer, please visit cnbc.com/Mad Money disclaimer.